Hi everybody, and welcome back to video number 6 in chapter 21. And when we left off, we were looking at income statement errors, improper classification of revenues or expenses. Number 1, we could have a current year error, and in that case, we would reclassify that item to its proper position. If it's a prior period error, we would restate the income statement of the prior year if comparative statements are presented. And sometimes there are counterbalancing errors, and that would be offset or corrected over 2 periods. So if the company has closed the books, alpha here, if the error is already counterbalanced, no entry is necessary. But for Bravo, if the error has not yet been counterbalanced, we would make an entry to adjust the present balance of retained earnings. So for comparative purposes, restatement is necessary even if a correcting journal entry is not required. So, counterbalancing errors will be offset or corrected over 2 years. Number 2 here, if the company has not closed the books. So alpha, if the error is already counterbalanced, no entry is necessary. And Bravo, if the error is not yet counterbalanced, we would make an entry to adjust the present balance of retained earnings. Now, if it's a non-counterbalancing error, not offset in the next accounting periods, then companies must make correcting entries, even if they've closed the books. Let's take a look at an illustration here for a counterbalancing error. The Sanford Cement Company failed to accrue revenue in 2023 when it fulfilled its performance obligation, but recorded the revenue in 2024 when it received payment. The company discovered the error in 2026. So the question is, alpha here, how should Sanford correct the error? And Bravo, if Sanford presented comparative financial statements for 2023 through 2026, do prior periods require restatement? Well, for alpha, the solution is the error occurred in 2023 and was offset or corrected by the end of 2024. No correcting entry is needed because the effects have been counterbalanced by the time Sanford discovered the error in 2026 and retained earnings is properly stated. For Bravo, Sanford must restate the accounts and amounts for the years 2023 and 2024 since they are being shown in comparative form with the 2025 and 2026 financial statements. Okay, so the procedures for correcting an error. Here's our illustration. If the books are closed for the current year and the error is already counterbalanced, no entry is necessary. If the error is not yet counterbalanced, we make an entry to adjust the present balance of retained earnings. However, if the books are not closed for the current year here, we're going to make, and the error is already counterbalanced, we're going to make an entry to correct the error in the current period and to adjust the beginning balance of retained earnings. If the error is not yet counterbalanced, then we'll make an entry to adjust the beginning balance of retained earnings if the books were not closed in the current year. Okay, failure to record accrued wages. Here on December 31, 2025, Hurley did not accrue wages in the amount of $1,500. The error is discovered at the end of 2026 before the books are closed. So the questions: Alpha, what is the impact of this error on 2025 and 2026 financial statement items? And Bravo, what action, if any, should Hurley take to correct the error? Well, for Alpha, in 2025, Hurley failed to make the following entry, where they debited salaries and wages expense and credited salaries and wages payable for $1,500. Therefore, the error impacts the 2025 items as follows. Salaries and wages expense is understated, net income and retained earnings are overstated, and salaries and wages payable is understated by $1,500. In 2026, Hurley actually pays the $1,500 wages and makes the following entry: debits salaries and wages expense and credits cash for $1,500. Therefore, the error impacts 2026 as follows. Salaries and wages expense is overstated by $1,500. The $1,500 expense should have been recorded in 2025 and then paid in 2026. Here, since the $1,500 is paid in 2026, the balance in salaries and wages payable would be zero. So no adjustment is needed to the payable because there is no longer an obligation. So for Bravo here, the books for 2026 have not been closed and the error is already counterbalanced. Therefore, Hurley should make an entry to correct the error in the current period. The entry in 2026 to correct that error is going to be a debit to retained earnings for $1,500 and a credit, a reduction to salaries and wages expense of $1,500. The debit to retained earnings will appear as a prior period adjustment to the beginning balance of retained earnings for 2026. All right, so here, failure to record prepaid expenses. In this case, in January 2025, Hurley purchased a 2-year insurance policy costing $1,000. It debited, incorrectly, insurance expense and credited cash. The company made no adjusting entries at the end of 2025. The error is discovered at the end of 2026 before the books are closed. The questions then are: Alpha, what is the impact of this error on 2025 and 2026 financial statement items? And Bravo, what action, if any, should Hurley take to correct the error? The solution would be for Alpha, the policy is for 2 years. In 2025, they should have recorded the insurance policy as prepaid insurance and adjusted at the end of the year to recognize half, $500, as insurance expense. Therefore, the error impacts 2025 items as follows. Pretty obviously here, the insurance expense is overstated by $500. Net income and retained earnings are understated by $500, and prepaid insurance is understated by $500. Now, the insurance policy expires at the end of 2026. If no correcting entry is made in 2026, the error is going to impact 2026 items as follows. And again, pretty obviously, insurance expense is understated by $500. Net income and retained earnings are overstated by $500. And no adjustment is needed to prepaid insurance because by the end of 2026, the policy has expired. So for Bravo, the books for 2026 have not been closed, and the error is already counterbalanced. Therefore, Hurley should make an entry to correct the error in the current period. And to do that, they're going to debit insurance expense for $500 and credit retained earnings for $500. The credit to retained earnings will appear as a prior period adjustment to the beginning balance of retained earnings for 2026. Okay, now we have an additional illustration here for overstating accrued revenue. In this case, the facts on December 31, 2025, Hurley accrued as interest revenue $8,000 that applied to the first 3 months of 2026. On that date, the company recorded a debit to interest receivable and a credit to interest revenue. The error is discovered at the end of 2026 before the books are closed. What is the questions then are, alpha, what is the impact of this error on 2025 and 2026 financial statement items? And Bravo, what action, if any, should Hurley take to correct the error? So alpha, the interest should not have been accrued in 2025. Therefore, the error impacts 2025 items as follows. And again, pretty obviously, interest revenue is overstated by $8,000. Number two, net income and retained earnings are overstated by $8,000. And number three, interest receivable is overstated by $8,000. The interest revenue should be recorded in 2026. If no correcting error is made, the error impacts 2026 items as follows. Here, the interest revenue is understated by $8,000. Net income and retained earnings are understated by $8,000, and no adjustment is needed to interest revenue because by the end of 2026, the interest has already been received. So for Bravo here, the books for 2026 have not been closed and the error is already counterbalanced. Therefore, just like the previous slide, Hurley should make an entry to correct the error in the current period, and the entry to correct that error would be to debit or reduce retained earnings by $8,000 and credit interest revenue for $8,000. The debit to retained earnings is going to appear, just like the prior slide, as a prior period adjustment to the beginning balance of retained earnings for 2026. All right, failure to record depreciation. Here, on January 1, 2025, Hurley Enterprise purchased a machine for $10,000 that had an estimated useful life of 5 years. The accountant incorrectly expensed this machine in 2025, but discovered the error in 2026. Hurley uses straight line depreciation on this asset. The question then would be, what entry would you record to correct this error on the December 31, 2026 financial statements, given that alpha, Hurley has not closed the books, and Bravo, Hurley has closed the books. Okay. This looks like a good place for us to stop this video, and when we return, we'll take a look at the solution for that. Until that time, bye for now.